Hello, this is Jeff Hildebrand for TBL Traders. This video is going to be on futures and hedging. I am going to spend a few minutes giving you some ideas, actually asking you some questions, because it's important to understand how these different products work together. I'm going to stick to the S&P 500 for the moment. I'll speak for a moment on gold, possibly. But what I'm going to tell you works across a wide range of products. I won't get into the details, but let me make some assumptions or propose some assumptions. On the screen I have the S&P 500 ETF. Okay? Let's say I own or I'm long 100 or 1,000 shares of this ETF. Question I'm asking is, do I have a short hedge, for example? Can I use futures or options to hedge that ETF? And I think that a good way to look at this is to, well, let's take an example. Let's say, okay, I see resistance here. We made a good bounce, and there's potentially some resistance here. I'm going to make a call. It's either going to break out because I'm going to follow the trend and go long, or I'm going to see this as resistance and I'm going to go short. These are the products I have at my disposal, basically. I have the ETF, so I can say I'm long, I can take my profit, and I can get out. The S&P futures, so if I want to be longer, I can buy one futures contract and be longer, using less margin than I would if I had the ETF, or I can use options. I've put up a July put and a July call and a July put, and the prices. The combination of these products would be how you hedge your long position. So I might buy puts here. Let's say I have a long S&P ETF position. I might buy some puts to hedge. Okay, so if it falls, I'm going to start making profit on my put position. I also might sell a short ES, the S&P futures. So I could sell the futures or I could buy puts. That's one way to hedge a long position on my S&P ETF. Think around the cost of these products. The premium on the puts will be lower than they would be in a falling market. So the puts, the VIX, if you look at the VIX will be falling now based on the rise yesterday. So the puts won't be terribly expensive. You could buy puts to hedge your long position, or you could sell a futures contract. What are the differences between these two? The differences are going to be premium and leverage. Keep in mind that the option, the price of the option and the leverage of the option is not the same. It's a 100 multiplier on a $1.70. Or basically you own 100, that represents 100 S&P ETFs. Okay, 100 shares of the ETF. This has a multiplier of 50. See the price. So I won't swing out this. It's funny, the market just opened and we're breaking out over the line that I talked about. I won't go into this too much in detail. What's important is to know that you have 3 or 4 products at your disposition to hedge whatever perspective you happen to be taking on the market. I'll say it again. You have the future or the options. You can be short the underlying and you can buy calls. You could be short the futures and buy calls. You could mix, you could create a spread here between the put and the call. So we'd buy both, for example, and we'd have a straddle. And we can add the underlying to this spread to adjust our trade. This starts to become a little more complicated, but keep in mind that it might be cheaper to use futures than options, keep in mind another important point is that the market is a living, breathing thing. So the market changes all the time. Using these 4 products for basically one trade allows you to adjust the trade with the life of the market. So as the market changes, you can adjust by adding or subtracting your trade. It becomes a little more complicated. You can set up spreadsheets for the calculation. You can start to look at delta and the Greeks, which are important if you're going to try to create these kinds of spreads and hedges. I would suggest you try this, and you try it slowly. So if right now the market's moving up, if I consider to believe the market's going to trend up, I would personally do one of 2 things. I would start to sell puts if I was in a long position, or buy calls to add to my long position on this trade. And I would start to then, if I'm going to do that, reconsider where I want to put in my stops. So that's basically how you use the products at your disposition to hedge the future, to hedge the underlying, even to hedge your option trades. You can do the same thing with other products. I put up gold here quickly because the correlation between the gold future and the gold ETF are very similar. You can see how they calculate it, basically a factor of 10 on the ETF and the futures. There are some things to be cautious here about. Futures trading and hedging with futures, there's another risk associated that you don't have when you're just trading options or you're just trading the underlying. There's something called limit up and limit down. That will block you from getting into or out of a trade that you might need to get into or out of to cover yourself. So there is an additional element of risk associated with option trading. Limit up and limit down is basically that risk. Be aware of it, and I think I will be talking about it in future videos. So that should give you an idea of how to delve into hedging with futures, options, and the underlying. Thanks again for the time. If you have any questions, don't hesitate.